What's up everyone, it's Scotty with MoneyVest Reads, and in today's video I wanted to summarize Peter Lynch's Playbook, and this summary comes directly from snippets of his two most popular books. These are One Up on Wall Street and Beating the Street, as well as multiple interviews of the great investor Peter Lynch. Now, bear in mind, it will be incredibly challenging and difficult for me to summarize every little detail of these two books, so I will try my best to give you a little bit of an overview and also a summary of what I believe are some of the most important lessons and takeaways from these two books. And this is by no means an exhaustive, detailed analysis of these two books, although I do plan to do multiple videos in the future kind of summarizing and going over different sections of these two books. But just because I don't want this video to be 30 or 45 minutes long, I'm going to break it down into pieces and break it down in multiple videos. Now, please also do consider reading these books if you are, an investor, or if you are interested in learning more about, markets and valuation and investing in general. These two books will significantly help in your understanding. And for those of you who don't know, Peter Lynch is an absolute legend when it comes to investing. He ran the Magellan Fund at Fidelity Investments from 1977 to 1990. So 13 years he ran the fund, and the annualized rate of return that he achieved was a little bit over 29.2%, which, needless to say, is a phenomenal market-beating return. And had you invested, let's say, $1,000 into his fund in 1977, 13 years later, that would have grown to almost $28,000, or in other words, 28x return in 13 years. So that obviously is a phenomenal number. Now, let's get started. So at the heart of Peter Lynch's philosophy, he believed that in order for a stock to do better than expected, it has to be widely underestimated, right? And otherwise, it'd be selling for a higher price to begin with. So when the prevailing opinion is more negative than yours, you have to constantly check and recheck the facts to assure that you're not being foolishly optimistic. And this kind of resonates a little bit more with, Howard Marks and what he's talked about in The Most Important Thing. Joel Greenblatt from the little book that beats the market, even Benjamin Graham and Warren Buffett, and a lot of the books that we've already summarized. And the stock's story is going to keep changing for the better or worse, but our job is to keep following these changes and act accordingly. In other words, there are three choices for every investor, right? So we can either bet with the crowd, and if we are right, we make average returns. In other words, if we bet with the consensus and the consensus is correct, we make average returns. If we bet against the crowd, and if we are wrong, that can obviously be dangerous and we can lose a lot of money, but the big money is made when we bet against the crowd. In other words, when we bet against the consensus and we are right. In other words, superior investing is all about having a non-consensus view and at the same time being correct. And this was exactly what was also talked about by Howard Marks in The Most Important Thing. I've already done a summary on that book as well. Make sure to check it out as well. Now, when it comes to portfolio construction, Peter Lynch believed that having the right stocks is very important to kind of balance out a portfolio. And a great analogy I can give you is that let's say that you want to set up a winning basketball team, right? Having 5 LeBron James on your team on paper sounds great, but that may not necessarily be the winning team, and it sure would lack in certain areas, and it would still have some weaknesses because it's just made up of the same player, right? So having a well-rounded and balanced portfolio was incredibly important for Peter Lynch and his investment philosophy, while also categorizing them in 6 specific buckets, right? So basically trying to understand, okay, these companies and which of these 6 categories these companies or stocks kind of fall into, which I'll go over in just a minute. Now, even though Peter Lynch did follow a very similar process to that of Warren Buffett and Charlie Munger and Howard Marks and Benjamin Graham of investing defensively, his focus of portfolio construction did involve being both on the offense and defense at the same time. So let's dive right into these 6 company categories that he, very famously mentioned in the books. And these are a way to separate some of the winning stocks from the losing ones. The first one was slow growers, right? So slow growers, as the name suggests, these are companies that have a slow growth rate, but are consistent dividend payers, right? They pay dividends to shareholders on a quarterly or at least on an annual basis, thereby increasing shareholder value. And it is important to determine what percentage of earnings are being paid off as dividends by the company. If dividends represent a small percentage of earnings, it is a positive sign because that's known as a payout ratio, and we don't want these companies to have a very high payout ratio because during hard times, it's possible the dividends do get cut if the company is looking for any cost-cutting measures. So we are looking at low payout ratio companies under this bucket. These are companies that may not necessarily grow as fast, but they are paying very consistent, stable, and heavy dividends. Now, the beautiful thing about these slow growers is that these are usually established blue chip companies that have a history of consistent dividends, right? Consider dividend aristocrats. And during times of stress, it's normal for investors to kind of flock to these companies simply for the dividend alone, right? That is considering the dividend and cash flows are stable and indeed strong. And a perfect example of these are going to be pharmaceutical companies or energy companies, for example, that pay a huge dividend. And they don't really grow as much, but they are very established and stable businesses to begin with recurring cash flows and dividends. And two things to make sure that these slow growers have are, number one, a strong moat. In other words, something that kind of sets them apart from the competition. And number two, the dividends are three things: paid, raised, and low in terms of payout ratio. Now, the second category for companies is going to be stalwarts. And stalwarts includes big and established companies, and they are businesses which aren't likely to go out of business anytime soon. And the key consideration here is to look out for the price to earnings ratio, which again is a valuation multiple that we have talked about, simply taking into account the stock's price divided by the earnings expectation and making sure that it's not super expensive or trading at very, very high levels. Now, if an investor intends to hold this stock forever, it is vital to check the company's performance during past recessions as well. Now, these are companies that kind of fit right in the middle, right? Stalwarts, they are growing faster than slow growers, but slower than fast growers. Fast growers is another company category which we will go over later in the video, but because of their size and scale, and because these are such large established businesses, they're not growing as fast as fast growers, but they're also not high dividend companies that are solely focused on growing slowly and just paying out dividends, right? They're somewhere in the middle. Now, perfect examples would be tobacco companies or beverage companies, consumer products like Coca-Cola, Procter & Gamble. I mean, these are companies that are established, have a decent dividend yield while also growing each year. But of course, because of their size, they're not growing revenues or earnings 2x or 5x every single year or over the course of, 5 to 10 years, right? So they are growing, but not as fast. And they also have a pretty consistent and decent dividend. Now, these are also companies with excellent balance sheets, so the probability of going out of business is also low. Now, number three, and one of my favorite ones, which is also the most complicated ones, is called asset plays. Now, asset play is a company that has something valuable to offer or some kind of hidden asset that only the investor can see and know about the company, and Wall Street most often overlooks that hidden asset or hidden value, right? So Peter Lynch calls these companies as asset plays because these are usually hidden assets which Wall Street has overlooked and has not accounted for or doesn't recognize. Now, the risk reward paradigm here is really good, as you can imagine, with low risk and high potential reward for these companies, because if you're sure about the hidden value or the hidden asset value of these companies, the upshot could be huge versus the downside risk, because if the asset is not really there, then nobody's talking about this company anyway, so nothing really happens, right? Nothing changes. But if the hidden asset or the value that we believe to be there is true and is materialized, then the upshot or the swing higher can be significantly worthwhile. Now, key factors to avoid with asset plays are, of course, high levels of debt, management dilution, and Peter Lynch says to sell when institutions finally arrive and their ownership increases to almost 60% or more, and the euphoria finally takes over. In other words, the hidden asset or the value is finally materialized, and you're seeing a lot of institutional investors jump in, and the trade itself or the idea is becoming too crowded, right? It's usually time to get out of that idea. And in a sense, we're trying to be early in these asset plays, and great perfect examples, think of Tesla or Nvidia in the early days, right? So when they were indeed hidden assets which Wall Street overlooked at the time, and they eventually went on to 5x or 10x over time. So this obviously does offer low risk, high potential reward. So that asymmetry when we're looking at risk reward trade-offs for investment styles. Now, number 4, and probably the most complicated category, is going to be turnarounds. Now, turnarounds are perhaps the most complicated category of Peter Lynch's strategy, and these are companies who have gone through a raid from bankers and creditors, and they're restructuring or transitioning into something new, right? Assessing debt structure of the business is the most vital part of the analysis, because they're doing something different, and it's the company's capacity to operate in a loss for some time while also working out its past problems without going bankrupt, right? So it's very, very important. These are companies that are kind of moving the ship or steering the ship into something different, whether there's, new management coming on board, whether they're launching new businesses or new products, or they're trying out something different. These are companies are turnaround stories, right? And they currently don't have any growth, and they're unfortunately poorly managed. And great current examples right now I can give you from my own sort of opinion is going to be PayPal or Walgreens, for example. And these are companies' potential turnarounds, right? Because they are, going through a transition right now. The new management is coming over. There's new company vision. There's current restructuring that's happening. So execution is very, very important in order for us to see that potential turnaround. If execution's poor, then that turnaround never happens. And obviously, they also have the highest risk potential. Now, Peter Lynch also believed that with turnarounds, Wall Street will ignore changes, and that's exactly why nobody wants to own the companies that I just mentioned or any other turnaround story, because Wall Street usually exits these companies because the old company has left such a dramatic impression on the people on Wall Street, on investors, that they can't see the new changes or the new company that's being built in this transition. So, and that's where the opportunity lies, right? If the execution takes over, then there's possibility for us to see big rewards and big upshots. Now, some checklist questions to ask yourself when you're looking at turnaround companies are: how will the company turn around? And are they going to sell a loss-making subsidiary? Will they cut cost? What's the impact of these actions? Or is the business coming back? Maybe they will launch new products, right? These are the questions, as well as can they survive a raid by creditors and short-term bankers and people who the company owes money to. Can they pay them off and still survive? And what's the cash and debt positions like? What's the capital structure? Can it sustain more losses for some time? If so, for how long? So these are all questions that need to be answered with the turnaround companies, and these are also usually high risk and high reward plays. Now we come over to the number 5th category, according to Peter Lynch, and that's going to be cyclicals. Now, cyclical companies are likely to perform well during certain seasons of the year, hence the word cyclical, right? They are very much dependent on market cycles, on business cycles, and they are known for the present extraordinary results during a particular season of the year. Now, Peter Lynch used to look at cyclicals during recessions because, being an optimist himself, he believed that when things will get better and the economy would recover and the spending would once again recover and the economy would expand, the cyclicals would be the first ones to rebound with a stronger economy as I mentioned, spending recovers. He believed that the best time to get involved with cyclicals was when the economy was at its weakest, earnings are at the lowest, and consumer sentiment or public sentiment is the bleakest. Even though cyclicals have rebounded in the same way in the last 8 times since World War II, buying them in the early stages of an economic recovery is never easy. But he says that obviously it's the difficult things during the difficult times that make all the difference for superior long-term investing. Now, Peter Lynch also believed that it isn't just about investing in great or excellent businesses, and this is something that I absolutely loved from Peter Lynch himself. He said that money can be made by investing in companies that go from lousy to mediocre, from mediocre to good, and from good to excellent, right? That money can be made in all aspects of that business cycle, right? All aspects of improvement per se. Now, it's when businesses go from excellent to being good is when investors begin to lose money. From good to mediocre, they lose more, and from mediocre to lousy, we're back to where we started. So we have to know what business cycle we're currently in, and timing the cycle and entering from a pre-recovery standpoint is only half the battle. Other half is picking the companies that will gain the most from the upturn. And if the industry pick is correct, but the company pick is wrong, then you can lose money just as easily if you were to pick the wrong industry in the first place. So there's a timing sort of aspect to this as well, going after cyclical stocks, but of course a risk reward is definitely there. Now, last but not least, we come to the last category, 6th, that is going to be fast growers. And again, these are small companies with massive growth potential, and companies with earnings growth rates of well over 20, maybe 25%, or are more classified as fast growers. It's important to investigate the product offered by the company and the share of the company's earnings from the product as well. The companies need to be assessed. Again, they need to be assessed on a regular basis because they're usually high risk, high reward, because majority of their valuation is built on the higher growth rates, right? So if the growth rate starts to dwindle or if it starts to deteriorate, well, guess what? The company can expose us to significant multiple compression and potential downside. One of the most mind-blowing things I've learned was that growth is not the same as expansion. Okay, and that is to say that the industry could be in decline. In other words, the industry itself could be in contraction and may not expand, but the company can continue to keep posting earnings growth. How is that possible? Because there's a lot of financial engineering metrics at companies' disposal, such as cost cuts, price hikes, share buybacks, only to name a few, which can boost the earnings for the company and its EPS and its bottom line. So earnings growth is the only growth. He says that earnings growth is the only growth that really counts, and that is so true because when you think about Wall Street, that's the only thing they really care about, right? They care about the bottom line and the earnings per share. Now, he also mentions to be beware of hot stocks in a hot industry because that leads to great competition, and companies can only thrive due to a patent, due to a niche or a competitive advantage or a moat. Now, in terms of when to sell, Peter Lynch says that hold companies for as long as the earnings are growing and expansion continues. Check the story every few months as if you are hearing it for the first time. And finally, I want to wrap up this section of the book and the summary. I promise I'm going to be doing more of these. Is Peter Lynch really believed at looking where nobody was looking. His philosophy was kind of mastering the style of investing of being early. And, his investment ideas kind of set the trend. So before it caught the attention of Wall Street, because institutions basically move the markets, he wanted to always be one step ahead of Wall Street, hence beating the street. In fact, he took this to a whole another level by specifically in the books specifying looking for boring companies, dull companies, companies that nobody is talking about, no analyst was covering it, no institution is following it, and these types of boring businesses kept Wall Street away. And Peter Lynch also tracked insider buying and selling activity because he believed that there could be many reasons to sell a stock, but only one reason someone would buy the stock because they believe it's undervalued. So there you go. This was a very, very quick summary of a part of a section of the books, Beating the Street and One Up on Wall Street. Promise there's going to be more updates because these books are filled with such interesting nuggets and snippets and, very, very important investing lessons and philosophies of Peter Lynch that it's impossible for him to cover everything in one video. So hopefully you enjoyed it. In our future videos, we are going to be diving deep into other aspects of his investing style. So always make sure that you drop a like and subscribe to the channel. Happy investing. I'll see you all in the next video.